Hey, so the market has moved a little bit, and here's the scenario that I've run on a rate and term refinance based upon an income qualification program that avoids that adverse market fee that the Federal Housing and Finance Authority has put into place. So I think you're going to qualify for this one. And here's what I've got. Currently, you're at 3.5%. You've got just about 29 years and 4 months left, maybe 3 now. We're going to roll it back to 30 years, which isn't a big deal, and drop the interest rate to 2.75. The total costs of the mortgage refinance process is going to be about $1,500. It's going to save you about $154 in interest the first year, which means this loan will break even in about 10 months, because if you take $1,527 divided by $154 a month, you're right at about that 10-month marker. So that tells us that as long as you hold on to this loan for 12 months, it didn't cost you anything. There was no negative effect of it. In addition to that, it would save you about $33,000 over the life of the loan and about $80 a month. So in looking at that, we're then going to come out to how I came up with that. Now, as I'd mentioned to you before, all loans follow the same protocol between long, medium, and short-term options. One thing to consider is we're going to try and keep this loan, and I'm going to change this to about $850 here. Actually, $824, I think is what I want. I want to get you to about where these are roughly even. But long and short of it is, at 2.625, you incur costs of about $3,800. At 2.75, you incur costs of about $1,500. So that's about a $2,400 difference in upfront costs. Well, when you look at the difference between the monthly payments between these two, it's only about an $8 difference. So if you're going to divide $2,400 by $8 a month, the difference in the monthly payment savings, you're going to see that it's going to take 24 years to break even. So here's the thing. The lower the rate, the lower the payment is the marketed approach by almost every internet and radio and TV advertiser, simply because they want you to choose the lowest interest rate, lowest payment option, because the odds are better that they're going to make the most money. So the question for you becomes, are you going to stay in this house for at least 5 years? For the first 5 years, 2.875 is actually cheaper. That's why it's illustrated in yellow here. But after 5 years, between year 6 and year number 24, this is the cheapest option for you. So I would definitely consider 2.75. If that's the case, that's what we've got here. It's going to save you $80 a month at a total hard cost of $1,500 and $33,000 overall. When we look at this refi breakdown scenario, one thing to consider: if the last payment you make is in December and we don't fund this loan until the beginning of next year, you got to remember every single day your mortgage balance goes up because another day of interest was added. And that's factored into that refi checker. So what I've done here is I've looked at the total closing costs of roughly $3,500. Those closing costs in this scenario are reflected across all options. They're all 30-year fixed options, as it shows right here. They just have different interest rates and different total incurred costs. So in this scenario, I'm reflecting the total costs. I'm also setting up a new escrow account, which is going to be about $2,400. And then you're getting a lender credit for about $2,000 to make the total net cost that $1,500. So you'd be bringing to the table about $475. Now, you can bring nothing as long as we get an appraisal that works for us. We're assuming an appraisal of about $282,000. And how I did that was just looked at the differences between Zillow, Redfin, Realtor.com, HomeBot, and Value Check to give me an idea of what we expect the value to come in at. Looking at it in this fashion, dropping that interest rate down, there will be mortgage insurance on the new one, just like there is on your current. It would reduce your payment by about $80 per month. Now, a lot of lenders would tell you, well, if you're saving $80 per month, that's going to save you X over the course of the loan. And here's the BS about that. It doesn't work that way. If I take $80 and I multiply by 360, like some incompetent lenders would tell you, they're going to say, look, you're going to save $28,000 over the course of the loan. But the reality is that the interest is considerably higher than just what's reflected in the payment. So on an interest ways, they would go, well, $154.39 over 360 payments is going to save you interest of about 55 grand. But obviously, as the loan amount decreases, so does the interest that's being incurred on both loans that you have. That's where we're getting about this 32.5. So bottom line is if you do refinance and change nothing within the next year, this was a good move. If you do refinance and stay here any longer than that, it continues to compound into a better decision over the course of the 30-year term to the tune of about $32,000. So wanted to walk through the details, make sure you understood everything. Let me know if you want to proceed.